Welcome back. Yesterday, while every headline in America was screaming about tariffs, recession risk, and collapsing markets, one of the most important XRP signals of the year fired almost unnoticed. On April 2nd, the White House announced the biggest tariff package in a generation. Stocks dropped, Bitcoin dropped, XRP dropped, and on that exact same day, $11.4 billion worth of XRP quietly left Binance, not sold, not dumped, withdrawn, moved into cold storage, institutional custody, and long-term hands. That is the part almost nobody is talking about. On the worst macro shock day of 2026 so far, the market saw fear on the surface, but underneath that fear, supply was disappearing. And at the exact same time, Ripple opened a new door that could matter far more than most investors realize. Starting April 1st, corporate finance teams at major companies gained the ability to hold XRP directly alongside operating cash through Ripple's treasury infrastructure. Same screen, same workflow, same kind of dashboard a chief financial officer already uses to manage liquidity, payroll, transfers, and cross-border operations. So here is the real paradox. The supply signal turned bullish. The institutional access story got stronger, and price still went down. That gap between what the chart is doing and what the infrastructure is quietly building is the hidden signal this video is about. Because when the market price moves one way, but the deeper plumbing starts shifting the other way, that is usually where the biggest setups begin. Now let us move fast through the hard data. Back in October of last year, centralized exchanges held roughly 3.76 billion XRP. This week, that number is down to around 1.66 billion. More than 2 billion tokens have been pulled off exchanges in under 5 months. That is a collapse of roughly 57% in immediately available sell-side supply. Now zoom in on Binance, because that is where things get even more interesting. Between January and March, about 3.8 billion XRP flowed into Binance from large whale wallets. In late February alone, more than $650 million came in during a single week. On paper, that should have created obvious pressure, but Binance reserves barely moved. In plain English, the market absorbed that supply almost as fast as it arrived. That means somebody was buying aggressively underneath the surface, even while the broader crowd stayed focused on fear. Then add the ETF layer. There are now 7 XRP funds trading in the United States, holding more than $1.5 billion in assets. More than 780 million XRP is effectively locked inside those vehicles. That is not retail panic money. That is institutional positioning. And unlike emotional traders, funds do not usually hit the sell button just because one ugly macro headline shows up on a Thursday morning. Then look at the chain itself. Activity on the XRP ledger is climbing back toward levels not seen since 2022. That matters because it suggests the network is not just being talked about, it is being used. Settlement flows are rising. RLUSD activity is growing. Institutional interaction with the infrastructure is becoming more visible. Now, if this were only an on-chain story, XRP should look a lot stronger than it does, but this is where most people miss the plot. On-chain data can tell you the setup is improving. It cannot force price higher on its own. It can set the table, but macro decides when dinner gets served. And right now, macro is the wall in front of everything. Here is the clean version of the logic. The tariff shock matters because tariffs act like a tax on imported goods. When import costs go up, companies do not just smile and absorb the pain. They pass those costs through. That pushes prices higher across the economy. Higher prices mean hotter inflation, and once inflation starts threatening to reaccelerate, the Federal Reserve gets trapped. That is the key. XRP does not need just good crypto news. It needs financial conditions loose enough for risk appetite to return. If inflation stays sticky, the Fed cannot cut rates with confidence. And if the Fed does not cut, money keeps sitting in safer places. Bonds, money market funds, cash instruments, all paying yield with far less volatility. In that environment, Assets like XRP have to fight uphill for every dollar of demand. That is why the tariff story matters so much. It is not just politics, it is not just trade, it is a direct chain reaction. Tariffs increase inflation pressure. Inflation pressure delays rate cuts. Delayed rate cuts keep liquidity tight. Tight liquidity suppresses speculative demand. And when speculative demand gets suppressed, even strong XRP-specific developments can get buried under a broad market risk-off wave. There is another piece to this. XRP is no longer trading like some isolated crypto side story. As institutional ownership grows, XRP becomes more correlated to the same macro flows driving equities and broader risk assets. When the S&P 500 gets hit hard on tariff fear, XRP increasingly gets dragged with it. That means Ripple can announce something genuinely important, exchange supply can tighten, institutional products can expand, and price can still fall because the macro machine is louder than the token narrative in the short term. That is exactly what appears to be happening now, and that is why this moment is so important. Because underneath the macro pressure, the XRP structure is not collapsing, it is compressing. Supply is leaving exchanges, funds are holding large blocks off the market. Whale accumulation has remained active. Ripple's treasury infrastructure has now put the token closer to real corporate usage than before. The mechanism is getting stronger, even while the market mood is getting weaker. This is also where people need to stay honest. Less exchange supply does not automatically mean price goes up tomorrow. XRP already proved that. Price fell sharply from last year's highs, even while reserves were dropping. Why? Because holders stuck at higher prices were still selling into strength, trying to get out, trying to break even, trying to reduce pain. Supply tightening creates the conditions for an explosive move later, but only when demand arrives hard enough to overpower those legacy sellers. So the real question is no longer whether the setup exists. The real question is what flips the switch. And right now, there are 4 signals that matter more than everything else. The first signal is Washington. Watch the Senate Banking Committee and the progress of the Clarity Act. Because this is not just another crypto headline. This is the kind of federal framework that could make large institutions more comfortable using XRP directly in serious payment and settlement flows. If that process advances cleanly in April, the market will start pricing in the possibility that Ripple's infrastructure can eventually convert into real token demand at scale. The second signal is ETF flow data, not the headlines, the actual flows. If XRP funds continue pulling in meaningful net inflows while price is weak, that tells you institutions are treating this dip as accumulation, not failure. If those flows start rolling over for multiple weeks in a row, that tells you structural demand may be pausing exactly when XRP needs it most. The third signal is price itself, specifically whether XRP can reclaim and hold the key resistance zone around $1.45. That level matters because it is where the bearish technical structure begins to lose control. Without that recovery, the fundamentals can improve all they want, and the chart will still look trapped. With it, the market starts taking the possibility of a real reversal much more seriously. And the fourth signal is inflation data. Watch the next consumer price index report like a hawk. Because if inflation comes in softer than expected, the odds of a summer rate cut rise fast, and a credible path toward Fed easing would remove the single biggest macro headwind pressing on XRP and every other risk asset right now. That is the full picture. On one side, you have the biggest macro headwind of the year: tariffs, inflation pressure, delayed easing, and risk-off sentiment. On the other side, you have exchange balances collapsing, institutional custody growing, ETF supply lockup expanding, and Ripple quietly wiring XRP deeper into real treasury infrastructure. That is why this moment matters. The chart looks weak, the headlines look ugly. But the deeper signals are not confirming a death story. They are describing an asset caught between improving internal structure and hostile external conditions. And when that happens, the winning move is not blind optimism and it is not panic. It is attention. Watch Washington, watch ETF flows. Watch $1.45. Watch inflation. Because if those four signals start moving in the right sequence, the market will stop seeing XRP as a weak chart in a bad macro environment and start seeing it as a compressed asset sitting on a real demand setup. That is the hidden signal, and right now almost nobody is talking about it. This content is for informational and educational purposes only. It is not financial advice. Always do your own research before making any investment decisions. Until next time, stay sharp, stay informed.